Tell me in this environment though, in terms of the sectors that you maybe have changed and reoriented towards because of what we're going through with the global financial crisis, what in particular has caught your eye?
Look, the quality of the management team for us is more important than the industry. However, having said that, for example, we recently invested in a business that's one of Australia's top distributors to universities of chemicals and consumables. And if you think about a market like that supplies, so its customer base is scientific laboratories, if you like. And if you think about a market like that, as long as we're still, unfortunately, have health issues and things need to go off to a pathology lab, or as long as the universities are continuing to do research, there's a need for those sort of products. So it's somewhat not correlated to the economy. Similarly, we've got an investment in a business that does audio for festivals and outdoor events, which is a booming area at the moment. So there are some sectors that one can find. We're looking at some opportunities of businesses that focus on lower cost but essential items in the household. So there are those sort of pockets. There are definitely other areas which are more discretionary, which are struggling at the moment. And private equity firms are obviously, and the businesses we look at are not immune from the general economy. So there are definitely some areas that are much more challenging, I guess, to look at, and the quality of that management team has to be that much more outstanding to make it work.
Well, you also can see that you are running a business model which did benefit big time when the going was good, but in a world that is being compared with the 1930s, it is a big ask to really say you can deliver at the same rate of return as you might have, say, 12, 18 months ago.
Look, hindsight's always a wonderful thing, so nobody knows what the future is. I think one can only say that from an investment point of view, now's probably a better time to be investing than a year ago. Who knows if next year's going to be a better or worse year than this year.
What's changed in the last 12 months?
Look, the general state of the economy is clearly much worse than what it was, given the global financial crisis. The availability of debt is significantly worse than what it was. And therefore one's future outlook, if you like, there's a lot of fear out there and a lot of caution. I think from a private equity perspective, in either an institutional or a family setting, private equity's been around for a long time. There will definitely be some train smashers, for want of a better expression. There'll definitely be some businesses that that kind of don't make it through this cycle. And I think the clever private equity firms will focus very heavily on mitigating the risks and making sure that they go back to basics and just invest in fundamentally strong cash flow, well-managed businesses. Ensure you don't overpay for it, ensure you don't over-leverage it, and then really help add value to those businesses. Get involved in the board, roll your sleeves up and really help those management teams to grow those businesses.
And in terms of a time horizon for a company that you're approaching, what are you typically in this environment saying is sustainable in terms of delivering on the returns that you believe you can?
Look, what we like to think of, Carson, is sort of a 3 to 5 year horizon. We think sort of 6 months or 12 months is too short term, and that's obviously one of the challenges of being a publicly listed company, those companies that have to report every half or in the annual results. And 10, 20 years is sort of too long because you're always putting things off and saying, well, we're going to get there eventually. So we like to look at a sort of 3 to 5 year horizon, work out strategically how do we want to take the business forward and agree that with the management team, and then really help give them the tools to go and implement that. And I guess the way I often judge the success of the relationships we have with the managers we back, if they're calling us a lot for advice and assistance, and that's a really good sign. If we're calling them a lot, it's probably not a great sign. And we've been very fortunate to have some great CEOs, and we get a lot of calls from them, and myself and my colleagues spend quite a lot of time with those companies, really helping them with not the day-to-day running of the business, because we don't fool ourselves into thinking we can run the management better than they do, but more with sort of the off-the-cuff sort of things that occur and the out-of-the-ordinary key strategic decisions, major financial decisions, and sometimes just people issues where they just want to have somebody outside of the business whose interests are aligned with them that they can act as a sounding board. But 3 to 5 years is the typical horizon we look at.
Tell me about how you arrived at this $50 million cap that you put on the funds under management. You've got your private investors, but you shut things off at that moment. What was so special about $50 million?
Look, for us, we were just sort of fortunate we raised the capital within a couple of weeks, and the reason why we wanted to sort of cap out at that amount is that Anacacia Capital, like other private equity firms, really looks to invest in, say, 8 to 10 businesses over the course of its fund. And because we wanted to focus on small, medium-sized businesses, if we'd raised a $1 billion or $5 billion or $10 billion fund, like some of the large global funds, we just couldn't focus on the small to medium-sized enterprises. And that's what we enjoy doing. That's where our track record is. We're lucky to have some people that have got some very good big company experience, but they've also applied that in an SME environment, if you like, and that's our focus, and that's why we sort of cut the fund at that size, and ultimately, you know, we've got a responsibility to our investors to generate some strong returns, and we think that's the space that makes sense for us.
Tell me about the Business Advisory Council as well. How important has that been to get traction, to get credibility early on in the piece with those out in the community to know that you are who you say you are?
Look, we're fortunate. I mean, my background was I used to chair a private equity business that was owned by one of the big banks. And in setting up Anacacia Capital as an independent fund, there's a big trend towards that. Investors like independent funds that are not owned by larger institutions. And you know, I really went to these people on the Business Advisory Council that have got deep operating expertise that I'd worked closely with before, said, would you like to get involved? They also, they want to invest in the fund. And you know, we're lucky to have people like a former head of Nestle and a former head of McKinsey and the current head of Booz and the former MD of, you know, Coates Hire and senior people from Futurus and Seven and other places. And we find that they're just really valuable when we're looking at investing in new opportunities. It's helpful for the founders to sort of see, well, here are some people with some deep operating expertise that can add some value to my business because they're very experienced in managing brands or very experienced in acquisitions or very experienced in other ways.
Because without that, people would perhaps quite reasonably be saying, well, what is your own understanding of what's going on the shop floor?
Yeah. So look, we don't, as I said before, we don't try and fool ourselves into running the business better than the management team. So we don't have a deep core knowledge of their business. What we do have is a knowledge of a range of businesses. And I guess I think what the founders and what the management teams value in us is an expertise across other areas. And typically when we make an investment, we'll, you know, put a couple of people on the board. We may have somebody that's got very deep industry expertise that's maybe spent 30 or 40 years in the media industry or in the equipment hire industry or in distribution or branded goods. And we may have somebody that's got very strong financial or transactional skills, particularly if we think we're going to help the business make a series of acquisitions. So it's something that, you know, we're very focused on, and that you're right, that's something that I guess is a little bit different about Anacacia Capital is we do have people in the business that have got quite deep operating expertise.
Yeah, exactly. I mean, if you look around, the team it was almost counterintuitive. It's lean and mean.
Yeah, look, most private equity firms just have half a dozen or so, you know, professional investment staff, and again, it's because they're not involved in the day-to-day running of the business. You know, they're there as active non-executives in the business. And that's why that's the model sort of globally, if you like. You know, the use of that sort of advisory council with deep operating expertise is quite common overseas. You know, it's not that common in Australia, but it's something that we've found really helpful when we're doing our due diligence and also to sort of complement our efforts on the boards of the businesses that we invest in. So that's kind of the leverage, if you like, in their private equity model in terms of people.
What would it actually take you, though, to reflect, reassess and say, well, in this environment, the model is not really best suited to being in the troughs. It is fine in the peaks, but down there we're just not doing what we should be doing.
Look, from our perspective, we're constantly reassessing, you know, where we are, as I'm sure, you know, most other, you know, good quality private equity firms are. I think the beauty of the private equity model is because it's over a 10-year fund structure. I think if you're doing it right, you don't try and time the market. You have to be absolutely conscious of the fact that we're in if not in a recession, pretty close to it, and the economic times are very different now to what they were a year ago. But if you're investing over a 5 or so year period and then exiting those investments over another 5 or so year period, and you're focusing on the fundamentals of those businesses, then yes, people are paying less now for businesses than they were a year or two ago, and yes, they're putting less debt in than maybe they would have beforehand. But they were probably paying too much and putting in too much debt beforehand anyway. So, you know, there will be sort of swings and roundabouts, and you definitely have to adjust for the environment. But you know, we're certainly seeing a lot more opportunities now than we ever have before, either through Anacacia Capital or in other roles that our team have been involved with. There's a big need for private equity in the current environment.
Okay, but you're also projecting what, say 5-10 years out, where we could see things perhaps swing back again. Would you bring forward any exit strategy, being mindful of that if things were to change inside that 10-year horizon? Yeah.
Look, we can certainly be flexible on exits. So we typically talk about this 3 to 5 year horizon. If it makes sense for everybody that we exit after 12 months and we all look at each other together with the management team and say, this is what makes sense, let's go for it, then we'll do that. By the same token, if it makes sense to hang on for another 3 or 4 years after that and wait for 7 or 8 years, we have the flexibility to do that. So it's a rather flexible model in that sense. And that's, when private equity works well, that's how it gets executed.